No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about investing this morning, and I'm going to get into some areas. I'm going to share with you two key strategies that can help you greatly reduce the return on your investments. You know, I've talked before, in fact, about the Standard & Poor's 500 index. The S&P 500 index, like the Dow Jones Industrial Index, we see it every day on the news when they're talking about the market and whether it's going up or down or whatever it might be doing in that given day. Most of you probably know by now that the S&P 500 index is represents the 500 largest companies in the United States, okay? These 500 largest companies make up 70% of the money that's in the stock market, right? That's the equity in the stock market made up by 500 companies, 70% of it. That means that only the balance, the 30% that's left, we have, like, I don't know, I think it's over 5,000 or more companies that make up that amount. So think about that. These 500 companies are the largest. And here's something else, an interesting statistic. Tony Robbins talks about it in Money Mastery. 96% of mutual funds do less than the S&P 500 index. Let me rephrase that in another way. The S&P 500 index outperforms 96% of equity mutual funds. So those mutual funds that you own, the equity mutual funds, stock mutual funds that you own currently, whether you own them individually, whether you own them as a part of a 401k or other retirement plan, maybe your IRA, 403b, maybe your thrift savings plan, the TSP. It is made up, of course, the C fund itself is, in fact, the S&P 500 index fund. The S fund is the balance of the market, if you will, 4,500, 5,000, something like that stocks in it. And then the I fund of the domestic market, and in the I fund, international stocks. So when we're looking at the stock market, if the S&P 500 index outperforms 96% of mutual funds out there, what do you have in your current portfolio? You know, one of the things that I hear from clients many times is, how do you find out the right answers if you don't even know what questions to ask? So here's some questions that you might want to consider as an example. This is like a little quiz. In fact, in my book, 7 Steps to Financial Freedom in Retirement, I go through on page 90 of the book, and this is in the chapter, How the Smart Money Invests. And I'm going to make it available to some callers today. I'm going to send you out a free book. But here's the Retirement Investor Quiz. Are any of your assets, first off, invested in the stock market? So are you invested in the stock market currently? And again, if you have a 401k, IRA, any kind of retirement plan, or maybe even in just individual savings, you may have some of that money in the stock market in the form of either stocks, bonds, maybe you have REITs, which are real estate investment trusts, ETFs, exchange traded funds. Most of you, it's going to be mutual funds. They make up the greatest part of our retirement accounts. So, do you know what the needed rate of return is? So when you're investing, and how do you figure out what funds to invest in? How do you determine which of those mutual funds that are available to you that you should be in? And there's so many, thousands and thousands, in fact, of mutual funds available to choose from. How do you choose which ones to use in your portfolio? And this is one of the areas that is so important, because the wrong choice can make a huge difference. And if the S&P 500 index outperforms 96% of them, that sets you up right there, right? And the same thing holds true, by the way, on the bond side. When we look at the Barclays Aggregate Bond Index, it outperforms most of the fixed income funds. So there's some traps we're going to get into, as well as how to fix that. All right, so do you know what the needed rate of return is? Because your asset allocation will be based on what the needed rate of return is on your investments. So a lot of times I'll ask clients, how much money do you want to make on your portfolio? And they might say, well, as much as I can, right? Of course. Well, would you be okay if you lost 100% of your money in the next year? And nobody wants to lose 100% of their money. What about if 50% of your money? Would you be happy with that? And that's a very valid question, by the way. Now, most of you might think, well, no, I don't want to lose 50% of my money. And yet, in the last 15 years, from 2000 to 2002, the market dropped almost 50%. It was well over, it was like 43, 44% that the market dropped over that period. And it took to recover from that, took about 5 years. Then we had right into another bear market. From October of 07 to March of 09, the market dropped over 50% in that period. And again, about 5 years to recover. So, and if you look at the period, in fact, from 2000 through 2009, the first 10 years of this century, the market actually was down. Okay, it was down. It was a losing decade. If you had invested at the beginning of 2000, say $250,000 into the market, then by the end of 09, you'd have had maybe $220,000 left. Okay, you would be down $25,000 to $30,000 over that period. And that's if you did as well as the S&P 500 index, which again outperformed 96% of equity mutual funds, which means most people did even worse than that. All right. And now, since then, what are we looking at for the future? Because we look back and we hopefully learn from the mistakes of the past, right? We learn how do we diversify. See, one of the strategies I'm going to, in fact, two strategies I'm going to share with you today over that same period actually made money. Okay? Would you believe they actually made 5% a year at the time the market actually went down? So in other words, the difference being that your portfolio, that 250 would be worth about 400,000 over that 10-year period, as opposed to 220,000, right? Almost twice the difference. Do you think that's important for you to know how to do that? Well, we're going to get into that, but I want you to understand the traps first so that these strategies are going to make even more sense to you as we get into those. All right, so knowing what your needed rate of return is. If you need to make 5% on your money to be able to attain your financial goals, and what are those goals, right? We want to be able to attain and maintain our standard of living and our quality of life no matter how long we live. We never want to be poor. What's the trap? You know, when you see the people chasing huge returns or chasing these very speculative types of investments, chasing the next hottest stock tip or mutual fund tip, they're trying to get rich maybe, right? And what do we know about rich people? One of the things we see all too often in news, how many times do you see a celebrity, for instance, whether it's an actor, an actress, a sports star who made, you know, maybe tens or even hundreds of millions of dollars over their career, and now they're broke, they're bankrupt, okay? Well, what does that mean for the rest of their lives, right, in terms of their standard of living? So it's not about getting rich, certainly not about getting rich quick. It's about how to get financially free. And that means being able, again, to be able to maintain that standard of living and quality of life, to never be poor, to have the money that we need for the life that we want, all right, and to be able to provide for our loved ones as a part of that. So one of the things we do with the retirement income analysis is we take a look at your financial future and see, based on what you're doing today, what is that going to look like? Are you going to be able to accomplish those goals? Are you taking on more risk, for instance, than maybe you need to, and is that going to potentially cause you to miss out on those things, not be able to maintain your standard of living because of the risk you're taking and the fact that it could rob that from you at the time you might need it most? Do you even know that? Well, those are some of the things we want to get into. The other part of that is, for the first 10 callers, this is what I'm talking about, the retirement income analysis each week. For the first 10 callers, I'm going to offer this free to you. Retirement income analysis. You can call my office. We're going to send you out. Debbie's standing by to take your calls. My office number is 615-376-5325. I'm right there in Brentwood on Old Hickory, right on the Brentwood-Nashville line. 615-376-5325. Debbie will take your call. For the first 10 callers, we'll do a free retirement income analysis. She'll send you out a checklist of things to bring to your appointment, and you bring those things in. I'll also send you a free copy of my book, 7 Steps to Financial Freedom in Retirement. I'm going over one of the chapters in that with you this morning a little bit. All of that just for the first 10 callers. All right, 615-376-5325. Debbie's waiting for your call. When we come back, I'm going to take a quick break. When we come back, I'm going to delve into this and more about understanding what you're doing currently, some of the pitfalls there, how to protect yourself, how to understand asset allocation better, apply it to your current situation, and I'm going to share 2 key strategies with you that I use with my clients each and every day to help them get superior returns with less risk, okay, than the S&P, much less risk in fact. So join us here. We're going to be right back on the Retirement Report.